everyone, this is Chapter 2, Learning Objective 4, Preparing a Schedule of Cost of Goods Manufactured, otherwise known as COGM. In this video, I'll be discussing COGM, where we'll calculate the cost of raw material, direct labor, and manufacturing overhead used in production, and then calculate the manufacturing costs associated with costs that were finished during the period. All right, so if the next part goes a little bit quickly and you would like a refresher, please go back to the previous video, Chapter 2's Learning Objective 3, LO3, because there is where I walk you through each one of the T accounts for the finished good, even before that, the raw materials, the work in process, the finished goods, and how that really mirrors in a manufacturing company that of just the inventory for a merchandising company. So I kind of go into depth there. Here, I'll be walking through likely a reinforcer, hopefully a refresh of what you read in your textbook with some animated slides, and where I feel like the real value comes in. And if you're like, yeah, I get it, Sam, like give me the good stuff, then feel free to maybe listen to 2X or 3X or even skip towards the end where we'll be doing a number of quick checks. So if you feel really confident, skip to the end. If you feel like you need a refresher, I'm going too fast, go to learning objective number 3. Otherwise, without further ado, let's talk about product cost flows. Boom. Boom. Okay, so we have our product cost flows where we have our raw material T count, and it's just presented horizontally here instead of vertically. We have our beginning raw materials, then raw materials RM that we purchased throughout. Then we have raw materials available for use. In equals out, so raw materials available to use less what we have left over at the end of the period means that what was transferred out, what we used in production throughout that period, is that difference. So that difference was what we transferred into our manufacturing costs. So kind of like a little intermediary bucket. So this is like when you go on the shop floor and you're picking out all your glass. It's kind of in the bucket where it's still glass in a bucket. It hasn't started to be used yet in production, but it's there sitting to be used. So it's kind of like this placeholder. It's now our direct materials that are waiting to be used. From there, we add our direct labor, manufacturing overhead. So, we might add some glue. We might put a number of different types of direct materials together. We put the windshield, we put the steel cage, we put the tires, put the bolts, we have the machinery, depreciation that helps us putting it on there. So we convert those raw material or convert those prime costs, and we have all of those manufacturing costs here, changing our direct materials into a finished product or into eventually a finished product. However, it takes a while to become a finished product, so we have our work in process bucket, our second official bucket. Our first bucket of inventory is raw materials. Our second is our work in process. Here, this is just the intermediary. It's kind of like the on deck, the batter's on deck box. Okay. So, or waiting in line in the store, it's kind of that intermediary step. Work in process. Well, we had stuff likely at the beginning. So it's not like we end the month just with 0 work in process. We have some cars that are like half put together, a third put together, started, almost finished, somewhere in there. And we'll do a calculation in a subsequent video, but all you need to know is that we typically start off with something in the beginning. Then we add in all of the costs that we added throughout that month. So what were the glass? What's the labor associated with that? What's the depreciation associated with that? What are our prime costs plus our conversion costs? And that gets us to our total work in process for the period. So that's kind of like we started. This is our in for the work in process bucket. From there, we transferred items out. So we finished items. So what we started with plus what we added minus what we finished, minus what we ended with. So kind of we started with some stuff that was half done, we added some stuff, and we finished some things. So what we had worked on minus what we didn't finish means that we did finish a number of items. Those are called our cost of goods manufactured, otherwise known as our COGM. And those are all the things associated with what was finished throughout the month. And that now sits and is added to our third bucket, which is our finished goods bucket. So we start off with items on our shelf, cars in our showroom. Then we add in our cost of goods manufactured. And that's our cost of goods available for sale. Then whatever we didn't sell at the end of the term or end of the month, is finished goods. So we have available for sale minus what was left, and the difference is cost of goods sold. Similarly, if you have cost of goods available for sale and you know what you sold, you know how much butter you have left on your shelf, just to mix some metaphors from our previous video. Otherwise, a big overview, and I really like this, this visual from your textbook, of manufacturing costs. All right. So please take a picture, keep these in your notes and add around them because it shows that we have our raw materials, our direct labor, our manufacturing overhead, and these are all going to be part of our inventory account. We start off with raw materials, RM, and then we add in our conversion costs, our DL, our MOH, and then we go from raw materials to work in process to finished goods, transferring our ins and outs, ins and outs, ins and outs as they circulate through one another. Then when we actually do sell them, so somebody goes to our shelf and takes the butter to the cash register and buys the butter, that becomes a cost of goods sold. At that point that it goes off the shelf and is sold, it's a cost of goods sold and it hits our income statement. And as we saw in our first video of chapter 2, we have these overarching costs, these selling, general and admin, SG&A, as well as marketing costs, and those just go straight to go. When they are incurred, these period costs, they go straight to the income statement. And that is our manufacturing cost flow. Perhaps take a pause of the video, like I said, add in your kind of own sense making to this because we're all going to understand it a little bit different, and it's about engaging the materials and putting things in your own words and your own understanding. Make it messy. This is for you. There are no marks for pretty because the next little bit is going to be us applying this. Okay. All right. So overall, it's a closed system, meaning all the costs have got to go somewhere. So if we take the previous illustration and add some numbers, say we have direct materials of $500,000, took $100,000 of labor and manufacturing overhead of $200,000. Pardon me. We have $800,000 of our costs that are now being worked on. From there, eventually all of those costs will be worked on. Great. And translated from work in process to actually finished or cost of goods manufactured. And once they're manufactured, they turn into finished goods. Those finished goods, once sold, become cost of goods sold. And throughout the course, our $800,000 worth of product costs had an associated $150,000 worth of selling, general, and administrative costs. So both hit the income statement. This would be under cost of goods sold because that's related to the product costs that were sold, that were manufactured, then sold. And this is related to our SG&A. So we have them in different parts of the income statement because as you saw in Introductory Financial Accounting, we're going to do things like external accountants, external stakeholders like investors, potential investors, suppliers, etc. would want to know how much money does it cost you to actually produce the good, and then what is your bottom line going to be? So it gives us some information there. All right, a summary and then some examples. So when we have the cost classification, when we are producing some external financial statements, we need to know what are our product costs and what are our period costs. Within here, the DM, DL, MOH is going to be under the inventory bucket. Very rarely would you see anything kind of broken out further. Perhaps if it was a material use to the users, there might be a note on it, but in general, just say inventory. Then we have our period costs, which are expensed, as we talked about, the marketing and selling costs, the administrative costs, or SG&A. Okay, so when we want to know about predicting cost behavior, so we'll talk about in subsequent slides, this chapter, what happens when we have costs that go up and down. For example, the more coffee you sell, the more coffee cups you will need. The more coffee you sell, the more coffee beans and water you will need. But the more coffee you sell within a relevant range, which we'll talk about soon, don't worry, the rent for the Tim Hortons will stay the same. So understanding how all of these interact, we need to understand, okay, is this going to be a direct cost? Can it be easily traced? Is it going to be indirect cost? Is it not going to be easily traced? And then what do we do? Well, if it's not easily traced, it goes to our MOH, our manufacturing overhead. And in a subsequent chapter, we will talk about how do we allocate those MOH to the product. So we have some items that we'll be using previous knowledge, our building blocks, in order to allocate those. Then in the last learning objective of this chapter, we'll talk about how to use all this information into making decisions. Okay, but now it's time for some checks. Beginning raw material inventory was $32,000 during the month. $276,000 of raw materials were purchased. A count at the end of the month revealed that $28,000 of the raw materials were still present. What is the cost of direct materials used? Please pause the video and we'll talk. Remember, in equals out. Okay, so we have our Excel. Let us remember our in equals out. So if we have our beginning, beginning raw materials, or because it's all raw materials, I'll just say beginning. So we have our beginning of 32,000, and then we were told that we had some purchases, and that was our $276,000 here. So then we have our available to use, boom, available, or our in raw materials totaling $308,000. In equals out, so we have available minus, we were told that $28,000 was still available, so we have ending raw materials of $28,000, so I'm going to put negative $28,000, and so that means that the amount of raw materials that were transferred out or used, so raw materials used, transferred out, equals $280,000. So if you selected C, you were correct. All right, let's look at the next one. Right, second quick check. Direct materials used in production totaled $280,000. Direct labor was $375,000, and factory overhead or manufacturing overhead was $180,000. What were the total manufacturing costs incurred for the month? All right, well, manufacturing costs are direct materials, direct labor, and overhead, and they're all for the same month. So what we're gonna do is we're gonna have our direct material. Shoot, I think I just spoke to myself for a second. So I'll repeat myself and then I'll take a peek and go from there. All right, so all of our manufacturing costs, they're all our costs: direct materials, direct labor, manufacturing overhead. So when we add up all of these three, we are given $835,000 in manufacturing costs, which is B. So if you selected B and you know why, fabulous. And if perhaps you were like, oh, I thought it was A because I thought you were asking for conversion costs, or oh, I wasn't quite sure, all good. We often learn more from what we don't initially get right than we do from what we initially get right. The trick is to understand why. So mistakes are great. That's part of learning. I definitely know that helps me a ton, and the research and literature suggests that as well. So don't be too hard on yourself. Just understand why. And if you're not sure why, let's post a question somewhere, come to tutorials, come to office hours, book some office hours. All right, let's keep going. Okay, next question, number 3. Beginning work in process was $125,000. Manufacturing costs incurred for the month were $835,000. $200,000 of partially finished goods were in work in process inventory at the end of the month. What were the total cost of goods manufactured during the month? Friendly reminder, pause the video, give it a try, and then I'll come and talk to you in just a moment. Okay, so looks like I just skipped ahead or started talking and didn't record, but for continuity purposes, here we are. To go over, we started with the beginning work in process of $125,000, plus we added $835,000. So we had work in process, total work in process throughout the month worked on of $960,000. Less $200,000 for those partially completed units, and we are left with cost of goods manufactured, that is cost of those goods that were finished through the month that were then transferred to our finished goods of $760,000. So if you selected C, you were correct. So last question of this workbook of our learning objective number 4. We have beginning finished goods inventory of $130,000. The cost of goods manufactured for the month was $760,000, and what was left was $150,000. So what was the cost of goods sold for the month? Give it a pause, and I look forward to seeing what you have. All right, welcome back. So we have finished goods inventory beginning was B of $130,000, fabulous. And then cost of goods manufactured, so this is our finished goods inventory, stuff that was finished throughout the month, so our COGM that came from our Webb. So our COGM, or additions, that were added was $760,000. All right, this was a productive month. And so that means that our cost available for sale, or our total in, was $890,000. Then, so this was our in, or our available for sale. And then we have total finished goods inventory of $150,000. So this is going to be an out. So that tells us that the cost of goods sold is the difference between what was available for sale and what was sold. Or $740,000. So if you had B, then you would be correct. Awesome. Well, that's it for me for this video. Awesome job holding in. That's probably the most examples that we'll have in a single lecture video. So kudos to you, and I'll see you in the next.